Okay, so for today, we're going to take a look at an exercise that will demonstrate the importance of the Glass-Steagall Act, or what the point was, I should say, of the Glass-Steagall Act. So what you have in front of you is a theoretical bank. I mean, it says Chase Bank here, but what we're talking about is really just any theoretical bank, and you're looking at a income statement as well as a balance sheet for this bank. Now, the important parts of this to understand, right, are that the balance sheet includes the assets versus liabilities, which, when you take the assets, they may total up to a certain amount, subtract out the liabilities, and what you get left over is something that we call the net worth, or the stockholders' equity for the bank. And the values that we're starting off with here already have some influence going on to them. So I'll show you what the baseline values are on this sheet, where you can see that for a baseline, we start off with a bank that has $1,000 in reserves, takes in $10,000 in checkable deposits, makes loans of $9,000 because of a required reserve ratio of 10%, and has about $2,500 in securities, which we'll assume in this case can be a mix of either stocks or bonds. So in an ideal world, we would have a bank that would make safe investments with the checkable deposits that it has, because part of the agreement with a bank is this understanding that the deposits that somebody makes should be safe with the bank, that they shouldn't lose any value below the stated loss from fees or anything else that you were told about up front. There shouldn't be a surprise loss in a checkable deposit, because it's effectively just a place to store your money. So with that understanding, appreciate that the Glass-Steagall Act was trying to create an environment where the investing activities of a bank, which do pose some risk, were separate from the deposit activities of a bank, or the banking activities, I should say, of the bank. To understand why there's risk to the investing activities, you have to understand that there is a level of riskiness associated with different kinds of assets. So if you're looking at this box here that I've just highlighted, you can see that we have assets broken up into two kinds, stocks versus bonds. And what I have here for on an annual period is the average gain that's observed, the maximum potential loss, and the maximum potential gain, usually observed based on historical data, particular to U.S. securities. So first thing you should notice is that on average, stocks gain every year a lot more than bonds tend to, almost twice as much as bonds tend to. Similarly, though, there is a gain potential that is higher for stocks versus bonds. But at the same time, the loss potential for stocks is much higher than it is for bonds. This reflects what we would consider a risk appetite. If your risk appetite is high, then you may have a portfolio that is more geared towards holding stocks versus bonds, because with a higher risk appetite, you're okay with tolerating the potential for a large loss for any given reason. And that tolerance should allow you to invest in riskier assets that could lose a lot more value than if you were less risk tolerant and you wanted to invest in an asset that had a decent amount of upside potential, but also a very secure low end as far as how much loss could be incurred. So what we see here is that investing in bonds is safer because the upside potential is not as high, but at the same time, the loss potential is only a fraction of what could possibly happen if you're invested mostly in stocks. So let's take a look now at our bank's income statement. And what we see here is something closer to an idealized situation, where the bank is making around 30% of its total revenue from investing income. Under the Glass-Steagall Act, I'm pretty sure that the target was closer to something like 10%. So this is even 3 times larger than what would have been the ideal. But this clearly reflects a bank that is investing largely in bonds, because the investing gains for the year are around the same as the bond investing gains. And this bank is also losing around 5% of the value on its loan. So this loan write-off is just an assumption that the bank will make, or a reality the bank faces, that maybe 5% of the $9,000 that it loans out will not be paid back to it because people will default on those loans. So in this idealized situation, things are good, right? We can even make a more optimistic situation, which would represent a bank that is maybe less regulated and allowed to invest heavily in the stock market while also conducting banking activities. In a good environment, right, they could be, in a really great environment actually, they could be making upwards of 51% on their investments, which really enlarges this number, right? Remember, before we were looking at a number that was 2.7 thousand in securities, and that was coming from $155 in new investing income. With a 51% gain, we get like $1.3 thousand in investing income. So in a very good scenario, it can be great. It can also lead to an outsized proportion where the majority of the bank's revenue now is coming from investment activities. And it almost begs the question, like, is it a bank or is it an investment institution? Part of the fear, though, that sparked the Glass-Steagall Act was that these good times don't just last forever, right? So with as much of a 51% gain as being possible, there's also the possibility that the bank could face a year where it will face the maximum potential loss from a stock-heavy portfolio. So what happens if we simulate a drop actually in value of 37%? So just from dropping the bank's portfolio to the maximum potential loss, we see that they are experiencing a major drop in investment income, almost $1,000 lost in investment income. And although that doesn't fully wipe out their securities, right? Do notice that we're in a situation now where the stockholders' equity is actually negative. So with negative stockholders' equity, that would mean that the bank, to cover its losses, would have to turn some of its assets into some form of cash and try to use that to cover the losses incurred, or at the very least try to use whatever cash it has to meet its checkable deposits obligations. So this is also still assuming a relatively good scenario with the loans, right? Where there's still $8,550 in loans, which, if we look at that summed with the reserves, means that they still have around $9,550 in reserve cash. Or I should say, not just in reserve cash, but in cash between reserves and loans made. So for the vast majority of depositors coming to the bank, they'll be able to cover the deposits and pay people back their money, even with these huge losses attained. But, right, if we're looking at an investing scenario where stocks drop by 37%, it's really unlikely that the stock market is going to plummet that much while people are just still able to pay off the same amount of loans that they were able to pay off before. So what happens if we even double this amount and make it, instead of a loss of 5%, what if it goes up to like a loss of 10% of their portfolio? So that stockholders' equity drops even more dramatically now, and the bank is in the red at around $617. And if they were trying to meet their obligations to their depositors, they would only be able to meet up to $9,100, assuming all the loans were callable at the exact same time. Maybe they'd have to liquidate some other assets, but we would assume that some of these assets wouldn't be easily liquidated. I mean, we're talking about buildings, other kind of like equipment. You can't just see. It's very unimaginable to see a bank just sell its ATMs, for example, just to meet depositor requests. But this is inherently why the Glass-Steagall Act exists, existed at one point, because there was a fear that if losses became too large, for example, theoretically, a bank could lose nearly the entire value of its portfolio if it makes the wrong investment decisions. If the losses become too big, at the same time that other challenges are facing the bank, then you may end up in a scenario where it is really implausible that all the depositors or even the majority of depositors will get their cash back, which is a complete neglect of the bank's responsibility to keep depositors' money safe. In the nightmare scenario where the bank's investments lose 90% of their value and loans that need to be written off are around a quarter, then what you're looking at is a situation where only about 7,700, maybe close to $8,000 of the deposits could be paid back. There isn't enough money in the assets that the bank owns to even cover its total deposits. If we were to include securities, not even enough money in total securities and total assets owned to cover the checkable deposits. That is deeply concerning. So we did end up reversing the Glass-Steagall Act. I'm pretty sure it was 1999. Part of other financial deregulation that happened after the Cold War ended. And some people do attribute the reversal of the Glass-Steagall Act as part of the reason why the 2008 housing crisis became such a immense problem, with banks not having enough assets on hand to guarantee that they wouldn't go under in this form. There was an attempt to kind of take more control of this with the Volcker Rule, but it's maybe not precisely the same thing, right? In any case, hopefully the takeaway here is very clear that the Glass-Steagall Act tried to separate investing activities for banks from their banking activities, because the investing activities can pose a real danger to depositors getting their money back. In this scenario, if we were to look at the worst case happening for bonds with a maximum potential loss of 8%, well, we end up in a scenario where there are still, even with loans dropping as far as what can be paid back substantially, even with of the $9,000 in loans being made, over 2,000 of them going bad, there's still enough cash between just the securities loans made and the reserves to cover the checkable deposits owed to depositors. There is a level of protection that has been guaranteed here. Another way that you can get towards this level of protection, though, is by increasing the amount of reserves that the banks need to keep on hand. This all runs into the same problem, though, where we're trying to balance out regulation with the fact that we need banks to be multipliers of cash, and they're also part of an international financial environment, right? So the banks are not just competing within the United States with other U.S. regulated banks. They're also competing with banks globally that may be under different kinds of regulations. And part of the consideration of regulators is to balance out the needs of depositors with the need of the country to be competitive in its economic goals. Hopefully, this makes the Glass-Steagall dilemma clearer for folks. Thanks very much.